investors.
It's amazing. We really appreciate having you. What interests you about multifamily space? Tell us a bit more about yourself.
Well, uh, I have a full-time job that's pretty flexible. I can work remotely. And I'm currently a renter. I live in an apartment, and I've saved up a good deal of cash. I have a down payment for a home, and in the area where I live, I'm from Cleveland. It's kind of a good market for investing in real estate here, and what I've thought about is possibly getting into the apartment buildings business. And a very cost efficient way to do that is through the FHA program. If you take advantage of the fact that you can have up to 3 tenants and qualify for the FHA loan, so you can qualify for that low down payment. Obviously, you're going to get dinged with PMI and other stuff, that wouldn't be tacked on to your payments if you just did a more conventional loan, non-FHA. But I have a down payment, but it's not a very big down payment. But it'd be nice to the short of it is I'm thinking of buying like a 4-unit apartment building or a 3-unit apartment building, and in this market that could cost me to like 300 to 400K, and it'd be like paying for a house that makes me money. So that's why not get a house that makes me money? I'm still single. I don't have to worry about having an environment conducive to children or family yet. But I thought I'd get my toes in the water and get into the business, and I have a rough sketch of how to get there. So, I want to learn more. So
you're single that is amazing. Your first quadplex.
Yeah, quadplex.
Yes, sir.
And the ladies come pouring in, my friend.
Yeah, that's definitely the right way to go, because look, a lot of us, we were taught to get a single family house, right? That's like the American dream, but when you start thinking about the concept of cash flow, right? It definitely makes sense, the path that you're looking to go, David. So
yeah, my first real estate investment that wasn't my primary house was a 4-unit. So I just skipped all the single family stuff and went straight to multifamily. So I think I'm all for that.
All right. So, Esben, is it the first time with us?
Me? Hi, yeah.
First time.
Okay. You can tell us a little bit about yourself in 30 seconds.
Yeah, no, I'm in Michael Blanc's mentoring program. I seen the advertisement here on the Slack channel, so wanted to join, take a look and see what you guys got going on. We started out in the single family space. We have acquired one property and found Michael Blanc's channel and decided to go multifamily.
Boom. Edgar, is it the first time with us?
You muted, Edgar.
Edgar. Okay, we come back to Edgar. Who we got? Viron, Gay. Hello, Mom. Suzanne, Marzel and Moselle and Evelyn. Is it your first time with us?
Hello. Yes, this is our first time with you guys. I've seen it online, on LinkedIn. A little bit about myself. My wife's not here, but 2 years ago we started down the real estate path. Bought a duplex, and last year, 2 years ago, bought a duplex, and then last year bought another one. Which the second one we are currently house hacking, so I can understand where David is coming from. We're just a tad bit ahead of David. We bought the duplex. It was a fixer-upper. We spent about 5-6 months remodeling it, and we just got a tenant in 3 weeks ago. So it's covering all of our living expenses.
Boom. That's how you do it.
And we're in the Ohio market, by the way.
Nice.
You and David are neighbors.
Yeah.
I think that's where
Yeah.
Shaka is too.
Yeah, I think you're right.
All right, let's see.
I'm unmuted now, Keith.
Edgar, how's it going, sir?
Good. Hey, so I came to find out about the group through LinkedIn. I'm a retired Marine, just like Hutch. So I looked him up and started reading some of his posts on LinkedIn. Been doing investing, but I don't know Hutch's entire background, but I started investing while on active duty, and then finally retired. So I'm paying more attention to it now.
Rah. I had to go get a uniform.
Oh, that's right. That's good.
That's right. That's right. All right.
Hey, you see that fact back there?
Yeah. What is that?
I got that when I was on recruiting from the Philippine Islands.
Ooh. You was on recruiting in the Philippines?
No.
Okay.
That flag came from the Philippines Islands. The gentleman that got it from there passed away, and then the grandchild was cleaning up, and so they dropped it off when I was on recruiting.
Oh wow, amazing. All right. Gotta go page 2. Let's see. Suzanne, Winston. Brenda, is this your first time with us? There you
Hi,
go.
everybody. Yeah. Hey, how's it going?
Brenda.
Yeah, my name's Brenda. I'm from San Diego. I've been studying multifamily through podcasts and reading and things like that for about a year. I did the Michael Blanc SDA calculator training. And then I just invested in my first duplex in San Diego. And then I kind of did a big rehab and turned it into a short-term rental through Airbnb. So that project's done. And now I'm really I'd like to go as big as I can, as fast as I can with multifamily. And so this year, my goal is really to get really confident with my underwriting so I can ask other people for money. I've started to reach out to brokers. I'm getting deals, but I'm not responding to them as quickly as I should to retain that relationship. And the reason why I'm not is because I'm just not really confident in my numbers. So I was excited to see you guys blast on the Michael Blanc Slack line is where I found you guys.
Okay, outstanding. I appreciate you joining
Eric's
us today.
the man to take us there, man.
Yeah. So whatever questions you have, please make sure you drop in those questions. This is the place to ask those questions, right? I'm pretty sure Ethan and I are gonna learn a lot
every
too.
question
And
you can think of.
yeah, challenge Eric, make it worth his while. Right. Who else we got? Eric. Evan, is it your first time with us?
Yes, it is. I'm an investor located in Denver, Colorado, just getting into multifamily. Looking for cash flow and looking for big properties to get into, hopefully sooner rather than later, and just trying to wrangle in and refine all of the underwriting that I'm kind of working through in the markets that I'm looking at. So that's kind of what I'm trying to get done here.
Yeah, appreciate it. Bring your questions. Lethorn, Irvin too. Is it the first time with us?
Yeah, can you guys hear me?
Yes, you got a radio deep voice. Yes, we can.
Good evening, everyone. My name is Lethorn Irving. I think Edgar might have said it, but the same way he found you on LinkedIn is the same way that I found you. And I've been investing in real estate for about 4 to 5 years, mostly single family, done about 10 or 15 flips. A couple of rentals, had a single family. I do have a single family rental now, also had a 4-plex rental that I recently sold. Did a little bit of management of a 60-unit apartment complex, but I've never owned 5 or more unit property. So I really want to get more comfortable with underwriting, closing deals, and this looked like a great opportunity to soak up some information.
You've already knocked out the hard part then, managing. That's the biggest.
One thing, I mean, I haven't had, a great deal of experience, but one thing that I did find out really quickly is that you're always learning. There's always new situations. So, I'll never think that I know everything. Honestly, I still feel like I don't know anything, man. One property isn't really going to cover it.
Hey man, I tell you what, I started on the other end. I was underwriting. I had my Excel sheets. I could make the numbers look beautiful. They just look beautiful. I did all that, and it wasn't until the first time I knocked on a tenant's door to hand them a notice to quit, where I was like, they don't teach you this stuff. They don't teach
Yeah.
you how to interact with people. Like it all looks well and good on an Excel sheet until you have to start actually interacting. But then you get a lot of good stories where I get hugs from tenants because they're like, thank you so much for working with me. I'm so glad that I was able to stay here with my family. There's a lot of good that comes with a lot of the craziness. So that's good on you, Lethar.
Yeah, appreciate that. One thing I did find is that in my experience with that one property, 60 units, it was in Detroit, 2017, and I'm sure everybody knows how Detroit had been in the recent past. So this was in the heart of poor neighborhood. I think we had 17 evictions that were in process when I came on. So I did learn a lot of the negative side, but I really like to gain experience and information on, higher class properties, maybe more like the C and B properties. I was more like a D property. So I'm excited to be here, and thank you for having me.
Yeah, I appreciate
Thanks
you
for
joining
being
us.
here.
We're about 20 past the hour. I think we got a few more, but got about 20 past, almost 20 past the hour. I think we're gonna let Eric kick it off. So Eric is the director of acquisition for Four Oaks Capital. I personally have been working with this team since around July of 2019, and that's when we met. I closed on a 55 unit apartment complex with them in October of 2019. And I can tell you, the reporting has been phenomenal. I reach out to my investors constantly, and the report that they get presented on a monthly basis, they tend to not have any questions. So solid reporting, solid team. And in December, of course, most of you know that Heath and we closed 167 units with them. So we're going to wave top that project that we just recently closed, and we're hoping that we can spend about the next 40 minutes talking about any question that you might have had. All right. So without further ado, Eric.
Yeah, thanks, Hutch. So my name's Eric Shirley. As Hutch mentioned, I'm the director of acquisitions here at Four Oaks Capital. Just a quick kind of background on me. I'll give you kind of the 45-second overview. Much like many of you, I started in the single family realm. Started flipping houses while I was still in college. I had a buddy that dropped out of school to flip houses because he was making so much money in Charleston, South Carolina in the early 2000s. I've been involved in the single family realm for going on 2 decades, still have a residential portfolio in the single family capacity. Got into multifamily about 2 years ago, really cut my teeth on the educational side. I realized, as many of you guys are learning or have already figured out, it's a completely foreign language. And if you don't know how to speak the language, no one will take you seriously. And I'm not even talking about recruiting capital. I'm talking about speaking with brokers. Brokers get 20, 30, 40 calls a day from folks that want to get the good stuff. And if you can't speak the language, you're just not going to get it. So I formed Four Oaks about 18 months ago, myself and 3 partners. In the last 18 months, we've closed 8 deals, just under 500 units. Just shy of $25 million and raised $10 million of capital in the last 12 months. So we kind of went from 0 to 60 pretty quickly. It's been a phenomenal ride. And I forget who said it earlier. I think it was Lathorn, but the educational side continues to happen. We continue to learn every day. And on the acquisitions front, myself and my team, we handle all of the underwriting. We underwrite anywhere between 80 and 100 deals a month. Out of those 80 to 100 deals, we submit maybe 2 offers. And part of that's due to our conservative nature and really kind of the criteria we've implemented. And I'll touch on that in a few minutes. And then we close on average 1 to 2 deals a quarter. So of the 6 LOIs we would submit in a quarter, we close on about 2 of those a quarter on average. So it's a quick background on me. I feel I'm really honored and humbled to sit in this chair right now because I was sitting where most of you were sitting just a few months ago. And it's been amazing, but I sit here to tell you it can be done. Programs like Michael's program, I know Esteban mentioned that he's in that program. I did not go through the coaching program. I'm actually going to be hopefully coming on as a coach within the next couple weeks. But two of my partners went through the coaching program and saw phenomenal value in it. And, there's a million ways to get there. The coaching programs, whether it's Michael's or any of the other programs, are certainly accelerators. So I encourage you, if you're serious about this, you have to spend money to make money in certain cases. I'm certainly not advocating any one program, but education is key. And I encourage you to arm yourselves with that education because that's truly where the success comes in the marketplace. But today we're going to talk about one of our newest acquisitions, 167 unit in Augusta, Georgia. I'm going to quickly go over kind of a high level on the underwriting, how we found the deal. And then for me, I really like to open it up to a lot of Q&A. I'm super passionate about this stuff and underwriting. I'm a Excel and a numbers nerd, so I can get into the underwriting and talk for hours, but I'm going to try to keep it high level and really open it up to you guys to ask questions so I can provide as much value as possible. Let me share my screen here. All right. Can everybody see my screen? All right.
Yes.
So this is 167 units, and this is kind of a unit breakdown. We found this deal off market. We had developed a really good broker relationship with this guy. He brought us this deal. The ownership group is several Israeli brothers, and they have 14 properties, I believe, if I'm not mistaken, throughout, primarily in Atlanta. But this was their only property that wasn't in Atlanta. And so it just didn't fit their mold. They would fly into Israel once a quarter to check on the property. And it was becoming cumbersome for them to come in, spend all their time in Atlanta, and then have to go all the way down to Augusta. And then they weren't able to take advantage of any operational efficiencies. So it was just the right time for them to divest, and it was the right time for us to acquire. So it was a really good fit. One of the things we liked about this property is when you look at the unit breakdown, there's a tremendous amount of 2 bedrooms, and these 2-bedroom 1.5s are townhouses. Townhouses are, when you look in the apartment world, townhouses are the most high demand properties because of the layout. You have an upstairs that's traditionally your living area, and then you have the downstairs, like your bedrooms and whatnot, and then the downstairs where your kitchen and your den and your dining room are. So you don't have neighbors above you, which is a huge selling point, and you're able to get rent premiums for those. When you look at the rent bumps, they were very modest rent bumps. And when we went through the property and we were looking at it to underwrite it, let me pull up the operating agreement or the offering memorandum. But if you see here, Magnolia Park is the name of the property. What's in gray here, this is what we were looking to push the rents to. So for the 1 bedrooms, for example, we were pushing rents from $598 to $655. So when you're looking in markets and you're really trying to determine if a deal is solid, one of the keys is to figure it's very detrimental if you get over aggressive with your rent bumps, especially if you're looking at your first deal. Most folks want a huge place that they consistently air is on the rent bump side. And the reality when you're looking at rent bumps is you have very little control of how much you can push rents. You can do all your homework in the world, but at the end of the day, the market's going to dictate how much you're able to push those rents. What you can really control is the controllables, which are your expenses. We'll touch on that in a few minutes. But you can see we were trying to push rents to $655, and even at the rent bumps to that new number, we were right in the middle of the pack of these comps. And when you're looking at comps, a lot of times brokers will pull comps from all over the market that really aren't the most accurate comps. They're just trying to pull the comps that make the most sense to justify the purchase price. Well, in this case, you can see almost every single property is very close in vintage. They range from 39 being the exception, but the 60s to the early 80s, and the distance, everything's in very close proximity. Everything's less than 2 miles away. So from a neighborhood standpoint and a demographic standpoint of our targeted rent audience, everything was going to be very similar. So the fact that with our 3-year rent projections, we were going to push to 655, and that was still in the middle of the pack, was super promising. And you can see it held true with the 1-bedrooms, the 2-bedrooms. We were going to push to 730 for the standard 2-bedroom, 1-bath, right in the middle of the pack. Actually, significantly below the average price per square foot for rents. The townhouses right in the middle of the pack, and then the 3-bedrooms right in the middle of the pack. So if you can find an opportunity when your growth goals are right in the middle of the pack of what today's properties are commanding, you're in a really powerful position, because it means that the odds of you being able to achieve those rent bumps is very realistic. By the way, guys, at any point, if you have questions, feel free to jump in, ask questions. I love a good open forum.
Hey, Eric, this is Brenda.
Hey, Brenda.
Hey, are you saying that for the most part, you're in agreement with what the brokers provided to you here? You're not necessarily challenging any of this data. You think it looks pretty accurate, pretty fair?
Oh no, we doubt everything. Anything a broker sends you, take with a grain of salt.
Okay, yeah, that's what I
all of these numbers. We secret shopped multiple properties. We called multiple properties. So you definitely have to do your due diligence and confirm the numbers. But at the end of the day, all these numbers happen to be accurate. And we knew, like I mentioned before, the fact that we were going to be pushing to the middle of the pack with our 3-year rent projections it instilled quite a bit of confidence in our ability to hit those numbers. We had, just kind of backtracking, Four Oaks had invested collectively. There's 4 of us. We'd invested in right at 10 deals ourselves passively prior to coming into this. And that really allowed us to do several things. It allowed us to, and I highly encourage anyone that wants to get into this industry on the GP side, invest passively and learn from folks that are doing this successfully. The knowledge is crazy. But we learned several things. One thing we learned is where people are being aggressive with their projections. And I'm going to touch on some of those. But one of the other things we learned is things that syndicators were doing that we liked and things that they weren't. And there were 3 key things that we took away from our passive investing experiences. And it was lack of transparency, lack of communication. And those 2 are for us, those are paramount. Like, you have to be able to communicate openly and often with your investors. And Hutch mentioned, we send out a ton of reports that are very detailed, and we keep our investors in the know. And the second thing is, with that transparency, making sure that we're not trying to hide the bad things, because, someone mentioned it earlier. The one inevitable is that things aren't going to go to plan. You're going to have hiccups. You're going to have bumps in the road. And it's not about the bumps in the road. It's how you overcome those and being able to pivot and adjust your strategy to handle those. And those were kind of some of our key takeaways when we built kind of the foundation of Four Oaks, things that we thought that were super important. But to your point, no, verifying broker, the information that brokers give you is paramount, because they will, I never want to think anyone intentionally falsifies information, but in our dealings with brokers, we definitely have brokers that are very candid with us and are very forthcoming, because they know we're going to find it out regardless, because we're very thorough. And then we have brokers that have never found a bad deal, and they try to all provide feedback saying, hey, this isn't a good fit for us, and here's why. And then they come back and argue with my information and try to justify why I'm wrong, if you will. So it's really, and you'll learn those brokers as you go along, which ones are just trying to peddle deals and which ones actually, want to build a relationship and really want to do business with you for the long term. Does that make sense?
That was great. Thank you.
Yeah, absolutely. So we go through, this was a loan assumption. So if you're not familiar, when you're purchasing properties, there's really two ways to acquire them. You can put new debt on them, or when you're in the multifamily world, virtually all outstanding debt is assumable, which was something in the single family world was not the case. Assumable debt right now is very, very common. And the reason being is a lot of people are trying to churn and burn and get into new opportunities, because there's so many hot markets. So they're trying to divest, cash out, get their lump sum of proceeds, and then reinvest that in another opportunity to turn it into more money. Super logical. With a loan assumption, it's a little bit different than acquiring new debt because you're taking over the existing loan. And in this case, they had used up all of their interest only period. And so we're going to be taking it over, paying both principal and interest from the get-go. Oftentimes when you see loan assumptions, they're not at the most attractive rates. And the reason for that is we've gotten spoiled. Rates are unbelievably low right now. And, literally 12 months ago, a 4.5, 4.8% interest rate was phenomenal. You were knocking that out of the park. And today that's just obviously not the case. So with this specific deal, it was a 10-year term, 5.07% interest rate, 30-year amortization. They were several years into the term, and this loan had yield maintenance. So virtually every single multifamily loan has some form of prepayment penalty. There's defeasance, there's yield maintenance, and then there's what's called a step down. Step down is something that you really want to get when you're acquiring new debt, but you have to pay for it. You're not, basically you're going to pay points for it, or you're going to get a little higher rate because of that step down. You're buying the step down, if you will. But on a 10-year term, the way a step down would work is the first 2 years, whatever the remaining balance is on your loan, you have to pay a 5% prepayment penalty in those first 2 years. Years 3 and 4, you pay a 4% prepayment penalty. Years 5 and 6, you pay a 3% prepayment penalty, so on and so forth. And so that's called a step down because you're stepping down each year of ownership or every 2 years of ownership, and your prepayment penalty lessens. Yield maintenance is a summation of all remaining interest payments. So if you have a 10-year term on a loan and it has yield maintenance and you're looking to sell in year 3, that means you have to pay 7 years of remaining interest payments, which when you get into bigger deals, you're talking about millions of dollars in prepayment penalties, and it can be catastrophic to a deal. So this is a great example of that. This deal had yield maintenance. This group wanted to sell. So we had to do a loan assumption. If we put new debt on this to take advantage of the interest rate, we would have had to pay a significantly higher purchase price to offset the prepayment penalty. So this was at $7.15 million purchase price. The original ask was $7.6 million, I believe. We locked it under contract pretty quickly. It was an off-market deal. And then there were 2 deals or 2 backup offers to us once we had it under contract. I believe the highest of those was $7.8 million. So we got a really good deal on this one. We bought it for $42 a door, which is, I don't know how much you guys know about Augusta, but Augusta is a great secondary market. Has really strong growth drivers. There's a new cyber command center coming to Augusta that's supposed to generate upwards of $10 billion over the next decade. So there's some really strong economic drivers in this market that made us super bullish on it. It is a C property in a C neighborhood. What a lot of people look for when they're looking for acquisitions is they're looking for C-class properties in B neighborhoods, and then they're going to try to come in and convert that older property into a B property. This was a C property in a C neighborhood. It's going to stay a C property in a C neighborhood, which made it really easy for us to devise a business plan. Because as you saw on the comparables that I showed earlier, really all we have to do is stabilize it and get it to status quo and middle of the pack, and we're going to crush our numbers. Anything above that, we're really going to knock the cover off the ball. So it made this deal really kind of low-hanging fruit for us. The ownership group prior to us put a significant amount of money into the exteriors. They had just repaved the parking lot. They had a Fannie Mae green loan, which with a Fannie Mae green loan, that is agency debt, but you have to do certain things to check the box to make it green. And so they went down the water conservation path. They spent over $200,000 on putting in low flow toilets, sinks, shower heads in every single unit. So there was a significant cost there. What they didn't realize is this was an early 70s vintage product. And when you're dealing with low flow toilets primarily, 70s vintage plumbing does not like low flow. It was not designed to handle low flow. So they spent all this money putting in this low flow stuff in the units, and their plumbing lines weren't able to accommodate the lack of flush power, for lack of a better term. And so they had to spend another significant chunk of money ripping out pipes and putting in all new plumbing lines, which was fantastic for us. They put in all new windows, a new parking lot, half the roofs were new. So they did a significant amount of capital. They had a significant amount of capital expenditures on the exterior. On the interiors, they had put virtually no money in. So that's really where the value add came in, was we could come in, we could add some curb appeal. We're redoing the playground. We're putting a fence around the entire property with like a punch code or a key fob, if you will. So it will be a gated property moving forward. Finish some of the exterior work, but really our primary focus was pumping money into the interiors so that we could raise rents in that capacity. We had an acquisition fee, $200,000 in replacement reserves. This is a huge one, guys. There's some things going on in the marketplace right now that I think are really important to touch on. And people are super bullish on multifamily investing, and it's such a hot thing to get involved in right now. And it's weathered COVID really well, all things considered. It's done much better than people anticipated, especially compared to other commercial assets. So as a result, people are flocking to multifamily even more now, which is making it hyper competitive. But one of the things that there's really 4 key components. Right now, there's an eviction moratorium that will most likely be extended through September. But it started in August and it was supposed to end January 1st, but it's been extended. We're at the tail end of a market cycle. We're in the midst of a global pandemic, and we're in the midst of a transitioning political platform. And this is certainly not a political conversation, but when you're transitioning from one party to another, you're not entirely sure of what changes are going to be made to this space, how that'll affect the tax benefits. And so that creates some trepidation around not only the underwriting side, but also with your investors that you're going to have to be able to speak to. But because of all those 4 factors, we think it's really important to underwrite hyper conservatively and to be in a strong cash position. Esteban is in Michael's program. Michael Blanc talks about when you're looking at cash reserves, a very conservative number that most people like to use is $1,000 a door. That's a conservative amount of cash to have on hand. We take that a step further, and we went up to $200,000 a door. So we're in a really, really strong cash position, which is going to allow us to weather pretty much any storm that comes our way. Our closing costs were pretty low, but the primary reason for that was because it was a loan assumption. So we didn't have some of the new acquisition costs that would come with that. And then we'll quickly touch on the pro forma. So this property had a 10% vacancy rate that was fluctuating anywhere between 8 and 14% kind of on average, and a 5% bad debt rate. That number's a little bit skewed. These numbers came from the T12. That number's a little bit skewed because the majority of the bad debt came in the last few months, which needless to say with COVID, there's been an uptick in bad debt and collections. So that's important to keep in mind when you're looking at new acquisitions. But 15% total vacancy between economic and physical vacancy on the T12. You can see our year 1, we factored in 25% vacancy in the first year. That's very conservative, but it's necessary in these times. And that's a place that I see a lot of people falter, is they're too aggressive with their year 1 occupancy rates. It doesn't matter how well the property's performing, you're going to typically see a drop in occupancy or an increase in vacancy in your first year because you're turning a lot of units and you're putting a lot of money into the property, and you're going to intentionally have certain vacancies. You're going to be evicting bad tenants. So you need to build in a nice cushion. And I always encourage people, especially in that first year, to kind of overestimate those numbers. When you're underwriting, one thing you will find is
Eric, real quick.
Yeah.
When you get the T12, do they always list the bad debt delinquency, or do you have to sometimes figure that out yourself? And how do you do that?
That's a great question. So it depends. Oftentimes we do see it reflected out and broken out as a separate line item. But like I got a deal today that I was underwriting this morning, and they just had, I didn't know what the gross potential rent was. I didn't know what the loss to lease was. I didn't know, it literally had how much money they actually collected and the other income. And that was it. And it didn't have other income broken out. So I had no way to know whether they had So yeah, you really have to dig deep and talk to the broker and have them break those things out. That's a great point, Heath.
So if for the bad debt or the delinquency, do you just take what the average rent should be and then multiply that by 12 and then figure out what you actually got, and the difference between that would be your bad debt?
Yeah. So in a lot of times what I'll do is it's different from property to property and market to market, right? So if we're talking about a 1992 vintage B-class property in Atlanta, that's going to be a very different approach than a 1970s property in Augusta in a C-class property in a C-class neighborhood. So in this case, we felt like it was a conservative measure. So when I looked at the T12, I completely disregarded everything pre-COVID as far as bad debt, because that was, I don't want to say disregarded, but I kind of pushed it to the side. It really focused on the past 3 months. When we started looking at this deal, it was September. So we were, and we continued to tweak our numbers through closing. But really looking at the kind of a T3 more than a T12 and extrapolating out our annualized numbers from a T3 versus the T12, because we felt like it would be more accurate. Does that make sense? So we had 25% vacancy in year one. We're tapering that down to 15% vacancy in year two. And again, that's both physical and economic. And then 12% in year three and 10% in year four and in perpetuity. This is a market that averages around 6% vacancy in C-class assets. So the fact that we're coming in at 10%, our value add strategy is a 3-year plan. So really we're expecting a little bit higher. We give ourselves a cushion to gradually implement our value add strategy. And then year four, when the property's stabilized, that's really when we're going to kind of flatline our numbers, if you will. And at that point, if the market's dictating a 6% vacancy, this is one of the things that bothers me. Is a lot of folks, you'll hear a lot of the term conservative underwriting is being tossed around very loosely right now. So if you're in a market where it's an average vacancy of 6%, and you're saying we underwrote at 7% vacancy, technically that is conservative because you're above average technically. But is that really conservative? I don't think it is. I think if you're truly going to be conservative, you need to build in a bigger cushion than that. And there's really 3 places that I think of when I think of conservative underwriting that I look at. So people bring us deals all the time that they want us to partner with them on. And the 3 things I look for are rent bumps, what the percentage of rent bumps are in general. So if right now rents are $600 and they think they're going to push rents to $850 in 3 years, that's a pretty aggressive rent bump. What is their strategy to get there, and how are they deriving those numbers and their confidence level to get there, and kind of what that strategy is? Once that property's stabilized, what is their continuous rent bump from there? So you'll see a lot of people, like we invest a lot in Greenville, South Carolina, in that market. And that market's seen anywhere between 3.5% and 4%. It's like 3.7% average annual rent growth over the past 5 years. That's phenomenal. But I don't think that in today's climate, and with those 4 things I said earlier about eviction moratoriums, the political climate, the global pandemic, and the fact that we're at the tail end of the market cycle, I don't feel confident that that market's going to continue a 3.7% rent growth for five more consecutive years. If I underwrite with that 3.7% for 5 years, I have no margin for error. If we have 1 year where it's flat rent growth, my entire numbers are shot. Everything's shot. So that's a place that we look very, very carefully. If you look at the past 20 years, inflation, the Fed's done a really nice job managing inflation. And inflation's hovered right around the 1.9 to 2% inflation rate over the past 20 years, give or take. So theoretically, you would think that once the property's stabilized, it should at least grow at 2% a year, because that's kind of what inflation's dictating. Well, we underwrite, you can see here, once the property's stabilized, we're underwriting at 1.5% rent growth. So we're below inflation, which is that is a truly conservative number to come in below inflation, and gives us a lot of room for upside. One of the other things I look at, so that's the first one, is looking at rent growth. The second thing that we look at that's really important is looking at the cap rate. So if cap rate at purchase is really not that important, because you're not buying the property. If you're buying a true value add property, you're not buying it for what it's worth today. You're buying it for the future value. And in today's market, you are going to overpay for everything if you're buying off cap rate, period. That's just the way it works. So I don't mind overpaying based on today. Like, think of it this way. There's properties that have deferred maintenance and that are being mismanaged that could potentially have negative NOI. And we all know that a property's value is dictated between the ratio between NOI and, excuse me, I had a tickle in my throat. So when you're looking at that, you really have to say, all right, if this property has a negative NOI, technically someone should pay me to take it off their hands, which is ludicrous. The property still has value regardless of its performance. So we've bought things at like a 2 cap or a 3 cap on the front end because of how it was performing in that moment. And we're absolutely crushing it with some of those properties because we're not worried about the cap rate at acquisition. What you have to focus on at acquisition is the prevailing cap rate in that market. So if most C-class assets are trading at a 5.5 cap, let's say, that's your prevailing cap rate in that market. And when you're looking at your cap rate at exit, they say conservatively you want to add 10 basis points per year of hold. So if the prevailing cap rate at the time of purchase is a 5.5 cap, that means in 5 years, your exit cap should be modeled at a 6 cap. Well, we don't find that conservative enough. We're actually adding anywhere between 20 and 25 basis points per year of hold so that we can really build in that cushion. So for example, we modeled this one exiting at a 7 cap. Well, if you're actively sourcing deals, if you can find a 7 cap in today's market in a strong, like a tier 1 or a strong secondary market, please send it to me because I would love to partner with you on that deal, because finding a true 7 cap is very, very hard to find. So the fact that we're exiting at a 7 cap is really, really strong. We're adding, I believe it was 22 basis points per year of hold on this deal. So that's another place that we really look at, how we're being truly conservative. And then the last place that we're being truly conservative is when you look at the vacancy rates. And so we'll see these deals that people send us, and they're in strong markets. It might be in Atlanta or a Raleigh or a Charlotte, but they're averaging, once the property stabilized, they're looking at 4% year over year growth, which the likelihood that that's going to continue, it just leaves no margin for error. And we'll see it's a 6% average vacancy rate, and they're modeling it at 6% vacancy every year of the hold. There's no margin for error. And if I'm an investor and I'm looking at a deal where first and foremost, I want to protect my initial investment. You want to make sure your initial investment is protected when you're talking about $50, $100, $200, $500,000 you're going to put into a deal. You want that protected first and foremost. But if you're truly going to be able to hit the projections that the syndicator is telling you, you can't have deals that are at 4% average rent growth over the life of the hold. Something else that we look at that's super important is, do people build in a refinance into their underwriting? I'm not saying that there's still good deals out there that have a refinance built in. The problem with building a refinance into year 3 or 4 or 5, we don't know what years 3, 4, 5 look like. We're prognosticating, right? All of this underwriting is educated guesses. We put a lot of time and effort into making sure that our educated guesses are going to be in the ballpark, but it's all guesswork. We're predicting the future. And the reality is, when you look at, what years 3, 4, and 5 look like, look at what happened in 2008, 2009, 2010. You couldn't get money. Banks stopped lending. I don't necessarily see that level of catastrophe on the horizon. But if the only way my deal works is to do a refinance in year 3, that's the only way I can hit my investor returns, I don't know what the market's going to look like in year 3. And so we don't feel comfortable building in a refinance to make it work. We always build in a true disposition or a true sale. And if we're able to refi earlier, we'll certainly explore that option if it's in the best interest of our investor base. But we would never build that in intentionally. And we're seeing more and more of that now. Of bridge debt has become very cheap. And if you don't know what bridge debt is, it's basically when you take a property that needs a lot of work and that has high vacancy, agency debts, true non-recourse debt like that with low interest, they won't give you that money. These long-term like 10-year, 30-year AM, 10-year term, 30-year AM at 3.25%, they're not going to give you that loan if you have 25% vacancy. That's not a good deal for them. But you can get what's called bridge debt, which is typically a little bit more expensive, but it's a shorter term. It's a 3 to 5 year term. Well, if I have a 3-year term and it's a balloon note, and so the remaining balance of my loan is due at the end of year 3, and something happens in the economy and they stop lending money, what happens to my investor dollars when I can't do a refi at the end of year 3? I'm in a lot of trouble, and your investment is in a lot of trouble. And that's a problem that scares me right now that's happening in the marketplace regularly.
Yeah. Additionally, Eric, you also have a calculator that shows the predictability of return on investment. Is that something you're willing to show? How $100,000 can work for the next 20 years?
Yes, but I don't have it on this computer.
Okay, got you.
It's on my office computer, it's not on my laptop.
Yeah, but the essence of that calculator is just building in a refi, because a lot of times when you're building a refi, for those of you who have owned a single family home, same thing applied to multifamily. Chances are you're not going to get refinanced for 100% of the value of the property, right? So say, for instance, you get 60% of your money back, right? That reduces your reinvestment amount, right? So for instance, you got $50,000 buy-in on your first syndication. If you should refinance and get 60% of your money back, right? Most syndication is not taking, $35,000 off your as an initial investment, so it reduces your ability to reinvest that money, so be cautious about those refinance and get a portion of your money back. Eric, you want to expand more on that?
Also, that's a great point, Hutch. And it also artificially inflates the numbers. And that's another reason we don't like it. So think of it this way. If you invest $100,000 and someone does a cash out refi and they're able to return 70% of your investment in year 3, now you have $70,000 back, but you have $30,000 still tied up in the deal. Well, starting at that point, when the refi happens, all of the KPIs, the key performance indicators that show how good your investment's performing, is based off that $30,000 investment now, not that $100,000 investment. So they might say, hey, it's a 15% cash on cash return. And you're like, holy cow, that's a ton of cash flow. Well, 15% on your $30,000 investment is only $4,500 a year. I don't know everyone's financial position, and I certainly don't want to downgrade how much $400 a month is. I don't think anybody on this call can retire on $400 a month. And then they still have your $30,000 tied up as long as they want to have it tied up. And so it artificially inflates the numbers. It's a riskier strategy, and we just stay away from it in general. Matt, did you have a question, buddy?
I did, thanks. I was wondering what sort of rates I can expect for bridge debt.
So that's a great question, and it's unfortunately not a simple answer. They're all over the map. It depends on the quality of the product. It depends on the quality of the market. We're working on a 350 unit deal in Oklahoma City right now, and it's a catch-22. So the beautiful thing about bridge debt is not only will they finance the actual purchase price, but oftentimes they'll finance your renovations as well. That's the difference between loan to value and loan to cost. Loan to value, they're giving you proceeds based on the purchase price only. Loan to cost is they're giving you a percentage of the purchase price as well as a percentage of the renovation budget. So 75% loan to cost. If it's a $10 million property with $1 million CapEx budget, they're going to give you $7.5 million for the purchase price and then $750,000 for your renovation budget. That part is awesome. The problem is where it's a catch-22 is if you're buying a property with significant distress, deferred maintenance or distressed property, they look at that and they're like, well, that's a higher risk property as well. So they're going to raise the rate. But if you're in a strong market, like let's use Atlanta right now. Atlanta's on fire. If you're in Atlanta and you have a really strong product that has a good debt service coverage ratio, you're looking at probably 4.25 right now. If you're in a not so great market with a property that's significantly distressed, and that 4.25 is at 80% loan to cost, which is really strong. 80% loan to cost is fantastic. At a 4.25 rate, that's like free money in this game. If you're in, let's say, Tuscaloosa, Alabama. Is it Tuscaloosa? I don't know. If you're in a rural part of the country and the property has significant deferred maintenance, you might be looking at 70% loan to cost at 5.5%. So it really can vary that drastically. And if you've played with underwriting before, you know that the difference between a 4% interest rate and a 4.25% interest rate can literally kill a deal. That's how important debt service is. Like really understanding your debt service, understanding how it works, and having a strong lending partner. Much like Brenda, I think, asked earlier about brokers. Lenders are the same way. Lenders will tell you what they want to tell you on the front end, oftentimes, to get your business. And then when it comes time to actually lock in the deal, those numbers tend to change, and not in a favorable way for you. So it's really important to establish strong relationships with good lending partners to make sure that the numbers in place are going to be either the right numbers, or if they're gonna change, they're gonna change in your favor and not at your detriment. Does that answer?
Yes, thank you.
Hey, this is Brenda again. I was wondering, because interest rates are so good right now, when we're looking at an exit strategy, say somewhere like 5 years out, and we can maybe just assume that interest rates are going to be worse than they are today,
right.
Like how does that affect our underwriting, or like how do we think about that if people aren't going to want to maybe, I just don't know.
Yeah, no, it's a great question. We build that in two ways. We build it in with a conservatively inflated cap rate. So again, like Augusta, for example, we built in a 7 cap. So, if prevailing cap rates are at 6% and or in this case, it was a 5.7%, I believe, if I'm remembering correctly. The prevailing cap rates in that market are 5.7, and we're saying we're going to exit at a 7 cap. So that's a tremendous amount of cushion built in. And again, if you played with underwriting, you know the difference between exiting at a 6.9 cap and a 7 cap can change your proceeds at sale drastically. I mean, drastically, hundreds of thousands of dollars. So when you build in that cushion, it allows you to factor in a lot of things. It allows you to factor in if there's an economic shift. It allows you to factor in if interest rates go up. Typically, the reason people like shorter term holds, or they like the idea of a cash out refi earlier on in the process, is because the sooner we can have some form of event, if you will, whether it's a sale or a refi, there's some more predictability there. Like the likelihood, based on what's going on in the global economy with the pandemic, the likelihood that in 3 years interest rates are going to go up at all, or significantly, is slim to none. I mean, they might go up slightly, but I certainly don't see a major impact on interest rates in the next 3 to 5 years. But the longer the hold, that is certainly something you have to take into effect. We build that in both on our cap rate, and we build that in our cost of sale. It's just another place where you can add to that.
Yeah, additionally, so that is us doing our own due diligence, make sure we can sell the property in the back end. But in all actuality, when you calculating the net operating income, you are not factoring the debt service, right? So that is up to the purchaser to actually get their best interest rates.
Yeah, and the other thing to piggyback on that, Brenda, is if the market if interest rates go up, that means everyone, it's not like they're going up exclusively to you. They're going up across the market. And so the purchase price never factors in interest rates, right? If the numbers work out on the underwriting side, that's where interest rates come in. But everyone's going to be up against the same challenges. And so that's why when you're negotiating deals, if you're negotiating deals and you're looking at, all right, if someone, so like that Oklahoma City deal I was talking about earlier, we got 75% loan to cost, and the guy really wants a specific purchase price, and we're a little bit off. We're a couple $100,000 off on a $15 million deal. Where when we go in to negotiate down that purchase price, we're basically saying to this guy, listen, we're working with really strong lending partners, and it doesn't matter whether it's us, whether it's you, whether it's any Tom, Dick, or Harry that's involved in this market or that's involved in this industry. no one's going to be able to get better lending terms than what these companies are offering. So at the end of the day, everyone's up against the exact same constraints, if that makes sense.
So maybe the demand for multifamily at that time might go down a bit. And so you might have to be prepared to hold longer. And as long as you're cash flowing, your investors should be hopefully okay with that.
Yeah, absolutely. And one of the other things to look at that we like to build in, again, from a conservative nature, we have a property, 82 units in Greenville, South Carolina. And when we originally underwrote it, we underwrote it on a 6-year hold with a super conservative cap rate at exit. And we knew that we were being very conservative with those numbers. We're 6 months into our ownership of that. And we're on pace to hit, starting now, we're on pace to hit our year 3 projections in our first basically 18 months. So because of that, we're going to be able to exit in year 4 or year 3 and still hit our total 6-year return, that total amount, the equity multiplier, but do it in the first 3 or 4 years. And so it's always better to underpromise and overdeliver.
Mm-hmm. And then how are you winning deals with this hyper competitive market and being hyper conservative with those 4 factors?
Yeah, it's a great question. And that's one that doesn't get asked enough. So I'm glad you asked it. We have phenomenal broker relationships. That's step one. And the reason we got phenomenal broker relationships is because we provide very, very quick, very detailed feedback to our brokers. And so they know, within 24 to 48 hours if a deal is going to work for us or not, or if we're going to explore it further. If the answer is no, we tell them why it's no. So they've really been able to kind of dial in on our criteria. Doesn't mean they don't still send us garbage sometimes, but they at least know that we're going to give them feedback one way or the other quickly. And the other thing is we're closers. We closed 8 deals in 2020. So they know when we commit to a deal and we submit an LOI and it's accepted and we go to PSA, we close. And so we've built now a reputation that's allowed us to start getting the really high quality opportunities.
That's fantastic. That's why you got to be really confident in your underwriting so you can do that.
You do. And so, Brenda, you mentioned that earlier. I'll tell you, and a lot of people don't do this, and there's no right way to skin a cat in this game. My approach to this was I spent 6 months to a year on the educational side. I literally listened to hundreds of hours of podcasting. I read every book possible. I bet I underwrote between 100 and 200 deals that I was sending out to people that had experience to provide me feedback. I would take, folks, syndicators that had been successful. I would call them up. I would take them out for coffee. I'd buy them drinks just to get as much knowledge as possible so that when I actually reached out and I called my first broker for the first time, while on my end of the phone, I'm shaking in my boots and I'm terrified because I know that I get one shot to do this right. He didn't know because I could speak the language and I knew what I was doing. I could talk on an educated basis. And so being able to, talk to a broker that if you have a good relationship with a broker, talk to them and ask them about the phone calls they get. Every single broker gets the same phone call. It's, hey, my name's Eric Shirley. I'm looking for 100+ unit value add B and C class properties off market. Why are they going to send you their best stuff? Why would they send you their best stuff when they can send it to me and they know I'm going to close it?
Mm-hmm.
I don't mean that derogatorily. I'm just saying there's no brokers get paid when they close deals. So they're going to send it to people that close deals and you have to earn that.
Love it. Thank you. That's great.
Yeah, absolutely. So I feel like I've covered a ton of stuff here. At this point, I'd love to open, if there's anything specific on the underwriting, I'm happy to dive in deeper, but, I'd love to kind of open it up to kind of general questions at this point. And
good, because we got a whole bunch of them.
Good. Let them fly.
All right. What tips or rules of thumbs do you use for quick way to see if a deal pencils?
So that's a really hard question because there's not really like rules of thumb per se, because every market is very different and every asset or like if you're dealing with a C-class property, it's very different than a B-class property. If you're dealing with Augusta, Georgia, versus Atlanta. It's very different. I would say always take whatever numbers they give you. So here's a couple places too that people screw up. Taxes, property taxes. Make sure that you reach out to the tax assessor to find out what the property taxes would be at your estimated purchase price. I will tell you 10 times out of 10, they're going to be higher than you thought. I see that mistake all the time. Payroll. People always underestimate payroll. Payroll right now, depending on your market, is going to be anywhere between $1,000 and $1,200 a door a year. That's a big number, folks, but it's what the market's dictating. Insurance, you know, Esteban, you specifically being in the Michael Blanc program, he throws out that $350 a door number. $350 is damn hard to find right now for insurance. Insurance is going up nationally. And so if you use, it's always better to overestimate and trim the numbers down and win than to underestimate and get caught with your pants down. Those are three numbers I see underestimated every single day: payroll, property taxes, and insurance. When you look at the expense lines, there's controllables and there's uncontrollables. Utilities, uncontrollable. You have no clue what they're going to come in at. We've had properties that we had a massively high water bill on, and we found out that one of the tenants was running an illegal car wash on the property with our water. It's not good, right? We didn't know. Now we know, and we cap all the faucets. We remove every single faucet on the exterior of the property. People can't do that. Small upfront investment for a massive back-end protection. But certain things like that, you just can't control. You have to use the T12 and use those averages and understand they're going to come within that range. Other things are controllable. Insurance, you can shop it around. Property tax is not controllable, but all you have to do is pick up the phone and call the tax assessor in that county, and they'll tell you exactly what the taxes are going to be. Also, understanding your state's tax laws. South Carolina has something called ATI. ATI negates the increase in tax. I don't want to go down a rabbit hole, but ATI allows you in year one to have a lower tax burden. It will increase in year two. Some states are point of sale states. Point of sale states mean if I close a deal in 2021, in 2022, my tax burden is going to be predicated on the purchase price. Other states like North Carolina don't change they reevaluate taxes every 3 to 4 years. So if they just reevaluated taxes in 2021, doesn't matter what my purchase price was, my taxes will stay the same for 3 to 4 years. Some states will come out, and if you have to pull permits to do major renovations, they will come out and see what renovations you've done, and they will adjust. Even though you purchased it for 10 million, they'll now say, all right, well, you did these renovations, so now it's worth 12 million, and then they'll tax you on that $12 million back. So it's really, really important that you understand the tax laws in your state. I went off on a tangent there, but it was a good one, I promise.
All right, quick, another question. If a limited partner have two deals that they're comparing,
Yes.
what are some of the key metrics that they should focus on?
Yeah, so this is a tricky one. So everyone, it depends what your financial goals are. And Suzanne, I think you guys mentioned what Suzanne said earlier.
Yeah.
If you're trying to buy a deal and you anticipate living off of the cash flow generated from that deal, you want to find not a huge value add product. You want to find a stabilized asset. Typically, you want to find something that's like a C-class property in a B-class area that's already stabilized and just needs some minor CapEx things to be able to push those rents. It's already cash flowing well, and it will cash flow well from day one. That's probably a product that would be a good fit for you. If you're not looking to live off your cash flow, I would encourage you to I would encourage you to stay away from heavy cash flow deals, because typically heavier value add deals have much larger returns on the back end, and you will make much more money over the life of the hold, but the vast majority of it is going to come from the proceeds at sale. Our investor base, most of our investors are looking for shorter holds with larger payoffs. So like our optimal deal, and it depends, every deal's different and every deal's unique, but our optimal deal is a 4-year hold with about a 1.6 to a 1.8 equity multiplier, which works out to be between a 17 and 20% average annual return on a 4-year hold. The reason I like that is because now you get all of your money back. So say you put in 100 grand, you get your 100 grand back plus 80 grand back in those 4 years. Now you have 180 grand to reinvest in the next deal that does that. So from a true wealth, think of it as compounding interest. From a wealth generation standpoint, that's how you build massive wealth. We encourage our investors, do that. And this is what Hutch was talking about with my calculator earlier. If you invest, and this is not a Four Oaks promo, but if you invest with Four Oaks and we're able to turn your money at a 1.8 multiplier 5 times in 20 years, and you start with a $100,000 investment, you're going to end up, I forget the numbers, but it's like $1.6 million at the end of 20 years. Now take that $1.6 million and buy your own damn property, put all 1.6 million to it and live off the cash flow, buy a stabilized cash flowing asset. If you're getting a 10% cash on cash return on your $1.6 million investment, that's where the mailbox, the passive income comes in. So now you're making $160,000 a year. This is why I don't like cash out refi deals, because you put your 100%, your 100 grand in, and they say, oh, we have a 15% cash on cash return. Well, the vast majority of that is not coming from your $100,000. The vast majority of that is coming after they give you back 70,000, and now you have your 30,000 tied up, and you're making 4,500 bucks a year. You got to invest in a hell of a lot of deals for 4,500 bucks a year to replace your ordinary income. Whereas if you follow our strategy of building wealth and then using that summation of wealth to take down something on your own or partner with someone or put a large chunk of that into a cash flowing deal, that's when you're going to get your mailbox money.
So Eric, are you depending on appreciation at the exit on that one? I guess I missed like how it wasn't a huge value add. It was just a huge multiplier at the cash out. So at the sale.
Are you which scenario? Elaborate for me.
You said avoid cash flow and then have like your biggest payout at the exit.
Yes.
Right. And that's how you get that big multiplier. And
Correct.
So like what generated that value if you're not doing a value add play?
No, that would be for a heavy value add play.
Yeah.
Okay.
People, let me give you a great example, Brenda. A very close friend of mine who actually partnered with us on the Augusta deal as well, came to me with a property in Greenville, South Carolina, and he was so stoked about it. It was a B-class asset in Greenville, and the numbers were phenomenal. And he was like, I'm so excited about this. They asked me to help raise money. Like, it's going to be a great one. And he was like, I just want your 2 cents on it. And I looked at the underwriting, and I was like, run. Like, he got so excited because of the optics. It was a B-class property in a super strong market, and he got excited, and he put the cart in front of the horse. The reality was these guys had a built-in refi. They had 4% year-over-year rent growth, which is astronomical. And they were looking at like 7% vacancy throughout the life of the hold. I'm not saying it couldn't happen. I'm saying that if I'm playing the tables in Vegas, I'm not putting my money on that number.
Got it.
To me, it's a much higher level of risk than a true value add property that has a heavier lift. Does that make sense?
That does. Thank you.
So I'm going to ask you a follow-up question. You were talking about a scenario where people do the refi, like 2 years, get a bridge loan, and you refi year 2 or year 3, and then you return like say 60% or 70% back to the investors. And then the thing is that brings your IRR up, maybe 20%, maybe more than 20%. So how would you evaluate that? If you can enlighten me on that, that'd be super awesome.
No, so that you're completely correct. And that's why I call it artificial inflation. It's artificially inflating the numbers. So here's what happens, Vinky, and everybody's personal monetary situation is different, right? But most folks that we deal with don't have infinite amounts of money to invest. So they might give us $100,000, but they're not going to be able to reinvest until we return a portion or all of their money back, because most people aren't sitting on $1 million of liquid cash, right? So follow this scenario for a second, exactly what you said. If you give me $100,000 and I give you 60% back of it in 2 years, right? Now you have $60,000 to play with and you have $40,000 tied up for God knows how long. You have no control of that $40,000. Yes, you're getting 15% cash on cash, but that's $6,000 a year. Again, I'm not trying to downplay $500 a month. That's great, but you're not replacing your income with $500 a month, I'm guessing. So now you have $60,000. So now you invest in another deal with that $60,000. Well, now that $60,000 in 2 years, they return 60% of it in a refi, right? They give you $36,000 back. You have $24,000 tied up in that deal in God knows how long that you have no control over, and you're making 15% cash on cash. Well, now you're getting $3,000 a year. So now collectively you have $9,000 a year coming in. Once again, I'm guessing that's not replacing your ordinary income, but now you only have $36,000 of liquid cash. Most folks aren't going to take a $36,000 investment. Most minimum investments are $50,000. So now you have the bulk of your proceeds tied up in a deal that you have no clue when you're going to be able to get your money back to be able to reinvest it. You have $36,000 of random money that you can't reinvest in the deal, and you're making $9,000 a year. That to me is not how I see wealth building occurring, right? And if you look at my calculator, it breaks it down very clearly. That same $100,000 invested in a deal where we can return your money with those returns I was talking about earlier, every 4 years is going to give you a much larger sum. And if your true goal is passive income, the best way to get passive income is to invest large amounts of money, whether that's into a syndication deal or whether that's buying your own property and reaping the cash flow and keeping it all for yourself. That's where those large sums of money, there's a misnomer out there.
So I just wanted to ask you a follow-up question. I'm sorry to interrupt you. So you were thinking that, let's say 60% is given back year 2 or year 3 out of 100,000, for example, just to keep the math simple. So 40,000 is still in the deal. So you're getting the 15% on the 40%, or you're still getting 15% on 100%, right?
No, you get 15% on what you have left in the deal.
Whatever is remaining, okay. And then, but that could be, you're assuming that they won't get out of the deal year 5. It could be longer than 5 years, right?
Correct. And the reason for that is we don't know what 5 years looks like. Like the longer the hold period, and most deals that I see are the ones that have a refi built in that are exiting at year 5, like that are truly exiting at year 5. So say they do a cash out refi at year 2 and they're exiting at year 5, right? A lot of those deals are underwritten very, very aggressively. Again, not saying that they can't hit those numbers, but a lot of syndicators started in 2012, 2013, 2014. They were sitting on top of a rocket ship about to take off. You hear all this stuff about Dallas. I wish I'd started in Dallas in 2012. I'd be doing this call from my yacht. But like, if there's a lot of syndicators, let me put it this way, and I don't want to bash the industry because it's not fair, but there's a lot of guys out there that are not proven. They've never faced adversity. And the reason being is they bought in 2012 and they flipped out of it in 2014 and doubled their money. And then they did it again in 2014 and 2016. Those times are not, that's not reality anymore. That's just not the world that we live in. Multifamily was on fire from 2012 to 2018. 2019 got harder and 2020 is even harder, and it's just going to get harder. There's a tremendous influx of international funds, institutional money's flooding the market. It's becoming harder and harder to find good deals. And people get caught up nowadays in pretty pictures. And we see a lot of that, of these big syndicators are buying these beautiful properties in Dallas or Houston or Phoenix. And they have pools with swim up bars and fountains and all this great stuff. And not that those aren't great properties. Personally, I think they're overpaying for them because this is what people don't know about syndicators, Inky. And I think this is important, is as a syndicator, as a person leading the GP side, we make very little money on the life of the hold, especially in like an 80-20 split with a pref. The syndicator is going to make virtually no money off the cash flow. They make their money 2 ways, off of acquisition fees and off of disposition. And so a lot of these guys have gotten into a position where they have to do a certain number of deals because they have to have the acquisition fees coming in to be able to sustain their business. So it's not that there aren't good deals out there that are like that model. It's just, you really have to look at the underwriting and sort through it very, very carefully and make sure you understand the business strategy.
So what are the key things that you look into a deal, something like that, where it's a bridge loan and then you're refining in year 2 or 3 and then exit year 5? What are the main things that you will look into the underwriting before partnering up with somebody?
Yeah, I think it's those 3 key things I mentioned earlier, looking at what the rent bumps are and how aggressive the rent bumps are, because the market dictates rent bumps. It doesn't matter how much money you sink into a property, you can only put so much lipstick on a pig, right? So rent bumps is first, vacancy is second, like making sure that there's a cushion there. Like, let's be honest, who saw COVID coming? I certainly didn't, and I have a medical background. I didn't see a global pandemic. And then the third thing is cap rated exit. We've seen deals that are literally exiting, like the projected exit at year 5 is like a 5.2 or a 5.3 cap. What? Like, cap rates are so compressed right now, and I'm not saying they're not going to further compress. God knows, I hope they do. That's just going to make me a lot of money. But I'm certainly not going to bet your money on it. And that's the problem. That's why I mentioned that thing earlier about syndicators that started early on in the process. A lot of them have never been tested. And what makes me personally nervous about that is they've lost sight of what's important. Is they look at this as a money-making vehicle and they're getting rich off of it. They've made so much money over the past decade because you couldn't fail. You literally couldn't fail. It doesn't matter how good of an operator you were. If you bought in the right market at the right time, you could not fail. I can't stress that enough. It's not like that today. You have to be able to pivot and you have to be able to think creatively and think outside the box. So if you were to give, and again, I'm not trying to make it about me, but if you were to give me $100,000, I know what goes into that 100,000, what you had to do in your life to earn $100,000 of liquidity to be able to invest with someone that you've never met before. Like, that's a massive leap of faith. And we take that very, very seriously. That's a major responsibility. Some of these folks have lost sight of that. It's become, they've done so well and now people just beg to invest with them. And that's truly, people beg to invest with them and they fill up deals in 24 hours. And some of these guys, there's names out there on the podcast circuit and on the educational platform circuit. And I'm certainly not going to name names, but there's guys out there that have never done their own deal. These are guys that you would think are like Grant Cardone. You would think that they have done hundreds of deals and they've literally never done their own deal. They just have a massive podcast and they have a great Facebook or Instagram and LinkedIn presence, but they have no clue what they're doing. They're just marketers and they're damn good marketers.
So what do you think about the new new operators, like us, who are in the market now and we are learning, and then we like to pair up with other people, or, like one nugget that you will share with us, like somebody has to trust us with their money because we are learning and trying to make our space in the multifamily arena. So what would you tell us?
Start small. One of the biggest mistakes, and I was involved in the Michael Blanc stuff on the Slack side. He asked me to be an advisor in his Slack channel for a while. And you'd see folks that had never done a deal before. They're like, I'm looking at a $60 million deal in Charlotte. And like, to do a $60 million deal, you've got to raise $30 million in capital. Like, unless you're tied to, unless you and Bill Gates are like bosom buddies, don't go down that path. Start small, find a good property in a good market that has good bones, and start there if you want to start your first deal. What I would encourage you to do is learn how to raise money and then partner with someone like ourselves or Heath and Hutch or experienced syndicators that can give you a piece of the GP and bring you in and teach you the ropes, and you can provide value to them through capital raising. There's a proper way to do it. I just made that. What I just said is not the proper way to do it. There's a proper format, but do it the right way.
Keep your ass out of jail.
Yeah, exactly. but partner with someone that's done it before and help them raise money. And that's one of the best ways to build your portfolio, build your credibility. And we have some guys that work with us that thought they wanted to be GPs. And after working with us on a partnership side, they chose not to go down that path anymore. All they want to do is be capital raisers because they can get a nice piece of the pie just by raising money, and they don't have to deal. Being a syndicator is hard. All these programs and these books make it sound easy. It's not easy. It's hard. And the hardest part is when you find a deal and you close it, and then you have to asset manage it. Asset management, there's no books out there on asset management. There's no courses on asset management. It's trial by fire. And so find good proven syndicators, figure out a way to bring them value, and partner with them.
All right, so we got a couple questions. I think you might have already answered them. How to analyze the deal, you already hit that. Qualified financing, we talk about bridge loan versus Fannie Mae and Freddie Mac. Bringing the right investor, we kind of talk about that. As a passive investor, you need to know exactly what your financial goals are before you start talking about investing in real estate. Once you identify that, then you can schedule a call with your investor of choice. All right, so Omar,
I also think that for as far as the underwriting, there's a couple of questions here. And I think this is something that a lot of beginners run into, and that is, am I being too conservative? So a lot of times when you're starting out, like I even took my laptop up 4 hours to Huntsville to sit with the broker's underwriter and ask them, why are we always 300 to 500K off from what they're wanting? You know, and I showed them everything. They're like, yep, no, that looks good. Oh, yep. We actually, you know, we're a little higher on this, you're a little lower there, but you know, for the most part, this is the way it is. But you know, it just, you did a good job. It's just people are going to pay that much. So you got to be aggressive. So how does someone who's starting out know how much value that they're going to add should they give to the seller?
Yeah, and that goes into Omar questions as well, as far as how important is price per door when analyzing the deal? Is that something that we need to focus on?
Ooh, that's a good question. Yes.
Yeah. So as we know, we're looking at cap rates, we're looking at price per door, we're looking at NOI, a whole bunch of different matrix.
Yeah. So at the end of the day, there's a lot of things people, in my opinion, get hung up on when they're new. And cap rate is the number one thing, because the easiest way for someone to teach you how to analyze a deal is to look at cap rates, right? But the reality is, as I mentioned earlier, cap rate at purchase does not matter. It does not matter. We've bought deals at negative cap rate. Like, it just doesn't matter. It's not what it's doing today. It's what you're going to make it do. If you have a good, sound business strategy, price per door doesn't matter. Cap rate doesn't matter. None of that matters. What matters is having a good, sound, conservative business strategy and being able to execute on it. And if you have a good, sound business strategy that you can execute on, and it's reasonable and it's conservative and it's underwritten well, none of that other stuff matters.
But even if you've developed that business plan, how do you feel confident that the number you're putting on your LOI when you submit it is going to be something that's acceptable or reasonable?
To whom?
To the broker or their seller.
It's probably not in most cases. I mean, the reality of the world we live. That's why I underwrite 100 deals and submit 2 LOIs a month. I mean, that's the reality, is you have to sift through a pile of dung to find the little, rose at the bottom. Like, it's hard to find deals. And that's why a lot of people are opting out of being on being on the lead syndicator side and looking for other ways to get involved, like raising capital or helping with asset management or going into the PM world. Like, it's hard to find good deals. I guarantee you, every single person on this call, I guarantee it, I'll put every dollar in my bank account on it. The worst deal you'll ever do is your first one. Period. It just is. You're hungry. You want to get a deal done. You look at your underwriting and you're like, I know that's a little more aggressive than it should be, but I'm so close. I'm so close. And you sign off on the deal and it doesn't perform like you thought it would. And this is the reality of, but you got to get that first deal done too. It's amazing. That's one thing Michael Blanc nails, is the law of the first deal. We went from chasing brokers to try to get them to call us back to now I have 5 calls a week on average, I'd say, from brokers hitting me up trying to get on my list to be able to send me deals.
Yeah. So you talk about purchasing cap rate doesn't matter, but the biggest thing we need to do is be able to execute a business plan, right? So there's a question here that talks about, and this was on meetup.com, question that talks about how do I estimate rehab cost before I submit an LOI? Because we have to know what business plan we're going to execute, right? How much money we're going to put into a unit, right? So question is, how do you estimate rehab costs for LOI?
Yeah, it's another tough one. So
Yeah.
again, building your network of experienced. So one thing you guys will learn if you haven't already about this networking, not just this group, but overall in real estate investment in the multifamily world, is experienced folks are unbelievably generous with their time and knowledge. And so reach out to somebody and ask, because you can use rules of thumb like, we can typically turn a unit. It depends on the size of the unit, but we can typically do a full turn in a C-class unit for $6,000. It's about $4,700 plus appliances. So, but those are in our markets. Other markets aren't the same way. Exterior, you have to look at your roofs. You have to look at windows. You have to look at asphalt. That's another one. I didn't know when I started this how expensive asphalt is. If you have to reseal a parking lot, not a big deal. If you have to repave a parking lot, you're talking about hundreds of thousands of dollars. Like, it's ridiculous. Landscaping, signage, it's a good rule of thumb, in my opinion, depending on how heavy the lift is around $10,000 a door. More often than not, if I start at $10,000 a door, I can come off of it and I'll end up somewhere around $8,000, $8,500, depending on how heavy the lift is. And that's interior and exterior combined.
Right.
But it depends on the size of there's so many factors there. It's really hard to dial it in and make some, to paint with broad brush strokes. I don't want to do anybody a disservice with that.
Yeah. So I'm not sure if we dive into some definition as far as some of those things that we use in the underwriting, IRR, cash and cash return, equity multiplier. What does all those things mean whenever a passive investor hear that coming from an active investor when analyzing the deal?
Yeah. So IRR is basically your return on your money with a time value component. So the shorter you get your money back, the higher the IRR. The longer it takes you to get your money back, the lower your IRR. So some folks use that as their primary metric. Again, a cash out refi will artificially skew that number. Cash on cash.
Yeah, the cash and cash, of course, will be your rate of return on a yearly basis, not taking into consideration your equity from your proceeds from sale.
Correct.
Right, and then the equity multiplier is how well your money performed over the whole time for that property. Is it 1x, is it 2x, 3x, 4x? In most cases, a lot of deals you're going to see right now is usually from 1.7 to 2.0x and higher.
Yeah, and it's important with that because that number can be falsely skewed too, depending on the hold time. So if I have a 1.6 equity multiplier on an 8-year hold, that's not that great. But if I have a 1.8 equity multiplier on a 4-year hold, that's pretty strong. That's a 20% average annual return.
That's right. Yeah. So just being able to understand how those numbers are manipulated to actually make the deal work. Because look, the biggest focus is how well can we make your money work for you? Because that's the biggest goal when investing in syndication. How well can your money work for you? You have worked hard for it. And Eric talked about it as far as how long did it take for you to save $100,000? Probably a few years, right? And putting that into a syndication, you want it to work for you as hard as you work for it, so that's kind of one of the foundation of doing the underwriting on a property.
And Hutch, not to contradict you, but I think the most important thing that gets overlooked is returns on your money are fantastic. Protecting your initial investment is the number one priority. So when you look at aggressively underwritten deals, the more aggressive the deal is underwritten, the more risk that your initial investment is at. I would gladly take a 3, 4, 5% annual return on my money, but know that it's safe, than have a higher yield on the back end, but my money is at a higher risk of losing it in its entirety.
Yeah, absolutely. And that's something that Heath and I would talk about quite often. Number one rule of investing is not to lose money. The second rule is go back to rule number one. The third rule, of course, is to make money.
Exactly.
Right. So I totally with you. I understand it.
So we have another question. So this gets to the two types of bookkeeping, I guess. Whenever your property managers are paying you rents a month behind, so how do you track the money with your property managers? How does it fit in the T12 if all your, because this is something that happened to me whenever I first bought the 16 unit is no one was trying to screw me out of like 5 units worth of rent. But since those 5 units paid April's rent, or, we closed in March, they paid April's rent in March. We closed on April 4th. I was due those rents for April, but since they paid in March, they didn't show up. And I had to fight to get that paid to me because that was my rent, even though they paid it in March. So that's one of the questions. How do you track the money with your property managers in terms of sort of, I forgot the two types of accounting it is.
So
Cash and accrual. That's right.
Yeah. So the vast majority of property management companies will not use cash-based accounting. And the primary reason is because it doesn't factor in bad debt. So think of it this way. If you have a tenant whose rent is $1,000 a month, right? And they're 3 months behind, you're accumulating $3,000 of bad debt over 3 months, right? That's building up in your bad debt. And at some point, you either have to write that bad debt off, which most likely would happen at the time of eviction because the likelihood that you recoup that is slim to none, or that person comes and makes it whole. And that's what accrual-based accounting, which is what most PMs use, takes into account. So where it gets tricky, and this is super complicated, and this is a conversation for another time, but basically when you look at a performance sheet that's actual versus budget, right? And it says collect, like rents paid for the month are $40,000. They're counting $40,000, even though $40,000 wasn't necessarily collected. Because at the end of the day, as long as there's not a vacant unit, there's a chance you could recoup those funds. So even though it says 40,000, you might have only collected 36,000, and that 4,000 is carried over bad debt. But you don't reflect that bad debt on your balance sheet until it gets written off. So it's a nightmare, to be quite honest. It's really like, we hired a CFO for that exact reason, because we didn't know how to read the damn books and it was becoming a problem. So you really need to have a good accountant. That's really what it comes down to.
Amen.
Do you guys perform cost segregation studies on your properties?
Every single one.
Yeah. Every single one.
Yeah.
And that's one of the things that don't really get spoken on a lot because everyone's financial or passive investment situation is different. It's really hard. It's really challenging to build that into the underwriting model. So you get to use the depreciation based on your own financial situation or your investment situations. So it's really challenging for us to actually figure that out. So it's not factored into your returns at all.
Correct. And that's another thing, Vinka, you in particular, because you were asking some really good questions about how to interpret other people's investment opportunities. There are companies now, Madison Title, which is where Yona works now, that can give you basically what the cost seg is going to be at a high level and and allow you to build that into your return. Make sure you find out if that's built into that return projection that's being quoted. Not that it makes it artificially right or wrong, but if I'm telling you, I'm giving you if you're looking at two different investment opportunities and mine is a 17% average annual return and theirs is a 17% average annual return and theirs has cost seg built into that 17% and mine doesn't, those are very different performance metrics.
Yep.
That's something that's becoming more and more common.
Do operators do that sometimes where they'll add in the savings from your tax breaks into your IRR?
Started in the last 6 months or so. Madison rolled out a new program where they'll give you that number so that you can build it into your returns, which allows you to inflate your returns to it's not inflating, you're quoting accurate returns, but it's not apples to apples when you're comparing investment opportunities.
But
Gotcha.
I am confused here now a little bit. So how would you, convey that to your investors, right? Because investors not necessarily gonna see the depreciation or the cost seg the way you're underwriting it, right? So if you're inflating your returns that way, but those are not true returns because they're getting some tax benefits.
Yeah, so this company, Madison Specs, whatever they're
Specs, yeah.
Madison
Yeah,
Specs.
they basically have a program now where you can, for free, as long as you agree to do your cost seg with them, they will do a preliminary cost seg analysis before even closing that allows you to figure out what those returns would be. And you could do it like on $100,000 investment, you would have a rough idea of what the pass-through depreciation would be, which would allow you to give, because we all know all projections in a pro forma are hypothetical. Like they're based on numbers, but at the end of the day, they're all projections, right? They're based on educated guesses. And so it just allows you to further build that out. Does that make sense, Mika?
Yes, it does. Thank you.
Yeah. Just it's one more thing. It just ties into how important it is to properly vet the syndicator that you're going to place your money with. To me, that like I don't have a problem with people doing that as long as they're being upfront about it.
Is that a question that people should ask whenever they see their IRR?
It should now. It didn't. It wasn't 6 months ago.
It most definitely. Yeah, so Eddie was asking about stabilized deals. So yeah, definitely, Eddie. That's kind of one of the biggest thing we look for is stabilized deals, so we can get the most favorable debt from Fannie Mae and Freddie Mac. But if something doesn't meet that criteria, then of course we need to go with that bridge debt. Right. Estimated.
Okay, here's another one. Do you anticipate there being a significant number of deals available in a few years once interest rates are back up and balloons are due, because of the earlier discussion of cap rates being higher and refinance issues? Or do you think the market will be dried up as people hold, taking lower returns?
I think there's going to be a massive influx of deal flow within the next 12 to 18 months. Yeah. Not for that reason, though. I think people have gotten hyper aggressive with their underwriting, and it's going to be unrealistic. They're not going to be able to. They're going to dig themselves into a massive hole. So to me, that's the bigger concern than cap rates rising or interest rates rising. I think you're going to see an influx of properties that are either undercapitalized, or they have to sell because they're not. That's probably what it's going to turn out to be more than anything is due to undercapitalization. People are gonna, because that's the other thing is if you think about if you look at underwriting and figure out how investor returns are calculated, one of the major factors, if you're doing agency debt, because you're having to raise the capital for the CapEx projects. So the lower you can keep your CapEx budget, the higher the investor returns are going to be. So I think there's a lot of folks out there that are undercapitalized because they grossly underestimated what their capital needs were going to be. And as a result of that, they're going to run out of money, and they're not going to be able to achieve the rent projections, and it's going to be a massive snowball effect.
Mm-hmm.
Okay. All right. So I see some people drop out. Yeah, mind if we do a zoomie real quick, and then we'll roll on to the last few questions. So if you could turn the camera on so we can do, I think Heath called it a zoomie. All right. So widely known as zoomie.
I think that's a new thing.
Yeah, it's a new thing. So you get a picture. And please feel free to post these pictures on the internet, on social media. And if you had some key takeaway, just add those as well if you find information valuable. All right. Trina, are you still there? Johnson? Jameson? All right. All right. So picture. All right. 1, 2, 3. One more. 1, 2, 3. Actually, go to the second page. Here we go. This zooming thing is funny.
This is almost as bad as taking a real picture.
All right. Okay. All right. Thank you. Thank you much.
Here's another
Right.
question for you, Eric. So you set up your business plan, right? You have your underwriting. You have a good sense of where you want to go. How do you manage the metrics, and how do you work with the property manager to manage those metrics and ensure that they are doing what they're supposed to, or implementing the business plan?
Yeah, so we put together what we call a
Yes.
playbook. So anytime that we buy a property, we literally hand a 30, 40 page packet to our property management team at closing that has everything from annualized budgets to what our expectations are. And it's like a 30, 60, 90, 6 month, 9 month, 12 month. So it's really broken down and detailed. I don't want to not answer the question, but that's not we could spend another 2 hours on asset management. I mean, it's that big of a thing. The most important thing is hire the right management company the first time. I can tell you, having fired 2 property management companies in our first year with different properties, the biggest regret I have is that we didn't fire them sooner. Property management is everything. It doesn't matter how smart you are, how good your underwriting is. Your property will live and die based on the property management. That piece is paramount.
All right, here's one. What's your buying criteria?
Our buying criteria are where it was and where it is today are very different things. When we started, it was really anything that we could find that penciled out well, to be quite honest. Now we're at a place where we're starting to look at 200 plus unit deals in the $15 to $20 million realm. But really for us, if you're talking about buying criteria as far as there's 2 different ways to look at it. Buying criteria of what fits your scalability model is one thing. Buying criteria for what your minimum investor returns are is another thing. Our minimum investor returns are 15% average annual return, 14% IRR, and cash on cash. We really don't talk a lot about cash on cash because we buy heavier lift properties. We buy properties that have, a ton of not a ton, but deferred maintenance, vacancy problems, mismanagement. We come in, we play hero, and we reap tremendous rewards on the back end. So cash on cash is a number that we intentionally, I hate to use the word train our investors, but our investors look to us to the metrics that are important. And for our company, we look more at average annual return and IRR than we do at cash on cash return.
Well, that's because, as you mentioned before, the main goal is the wealth building as opposed to I need to live off of my investment, right? Is that?
Yeah, because
Correct, yeah.
again, for example, even this Augusta property is a great example. This Augusta property is going to be a home run. We bought it right, but it has terrible cash flow year one. It has like 0.5% cash flow year one. Years 2 through 6, fantastic. Great. If we could just average years 2 through 6, home run cash flow. But when you take 0.5% and add it into an average on a 6-year hold, it crushes your cash on cash. It's like a 5% cash on cash because that year one is so bad. But when you buy a distressed property, it's going to be bad in year one. I mean, that's what it is. But it's the nature of the beast.
All right. How do I strike a balance for purchase price calculations? This is for a distressed asset with a solid business plan in place.
Strike a balance. Sorry, whoever's question that is, could you elaborate for me?
They may not be on any longer. Yeah, I don't see them.
I'm not sure I don't know what that means.
All right. Any recommended books on underwriting multifamily deals?
Yeah, 2 of the best books out there are the Joe Fairless Ultimate Apartment Syndication book and Michael Blank's
the best ever syndication book.
Yeah, best ever. And Michael Blank's Yellow book are both great starting
Financial
points.
freedom to pass.
There we go.
Yeah.
Those are both great ones. Really, underwriting is a product of practice. There we go. Angels all over.
Yeah. Yeah.
That's the gold standard right there.
It is.
Underwriting is practice, 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 and failing.
Yeah. Also, if you savvy with Excel, you can create your own module, right? If you know exactly what the outcome you want it to be, you know how all the cells can talk to each other. But a lot of us on this call use the SDA syndication deal analyzer that was created by Michael Blanc's team. It's $130. It's the best $130 you probably will ever spend. It'll be just a foundation. Yeah, just a foundational Excel, and you can get to build on it. You get to build on it based on what outcome you want to create as you grow your underwriting skills.
And if you have the funds to dedicate to a coaching program, or if you have the funds, like one of our big platforms at Four Oaks is education through investment. If you have the funds to do an educational program, the juice is worth the squeeze if you're willing to put in the time and the effort required to be successful. I can tell you, as someone that's been asked to be a coach, where most people fail is they spend the money and they don't put in the time. They think it's a get rich quick. I spend 20 grand or 25 grand. I'm going to make that back in spades. If you don't put in the time, you might as well throw it in the fireplace.
It's funny that you say that. I was on Clubhouse this morning, and that's one of the things they were talking about. They're talking about the law of attraction, how you can attract all these great things to you, right? But we are all responsible for the miracle process. We all want some miracles in our life, but some of us are not willing to take the actions we need to take to actually realize the miracle. You know, so you can have the best coach in the world, but if you're not taking the action, your results will be mediocre. So, you know, go back to Eric's points.
Yeah, one of the other big fatal flaws, if you will, that I hear, it's a cliche and I hate it. It makes me nauseous because it's not true, is if you find a good deal, the money will come. And that is not true. That is a load of bull. That's not true at all. It doesn't, like, it's just not. So don't go into things with that mentality. Like, you need to be, while you're learning to underwrite, you need to be building your team. And when I say team, I don't mean like partners. I mean like third parties, lending team, legal team, accounting team, property management team in the markets that you're looking at. But simultaneously, on top of that, you need to be learning how to raise capital. You need to be talking to everybody you can about what you do and what you're trying to do. And this business, everyone thinks this business is about real estate, and it's not. This is a marketing business with a real estate backing. The best marketers win, period. If you can raise money, you make a ton of money. If you can't raise money, it doesn't matter how good your underwriting is, how good your deal sourcing is. You will never achieve success if you can't raise money, period. Period. I know that's harsh, but that's the reality. I'd rather save people heart. Like,
it's definitely,
you can't raise money, you will not succeed, period.
Yeah, you're absolutely right. And to your point, you know, whenever you go to submit an LOI or, you know, actually putting a property on a contract, knowing exactly where the funding or your equity, your capital stack will be coming from, it's important. So great relationship with your lender and great relationship with your investors is important to give you the confidence to communicate with the brokers and also putting the property on the LOI and then inevitably on the contract, you know, so to Eric's point, absolutely build those relationships so whenever you need them, you can execute on that property. So
and it's hard. Let's be honest, raising money's hard. So
it's
practice.
Challenging. Yes, I believe that is a great segue into what Heath and I we are aspiring to do in the next 24 months. So one of the things we're committed to do is getting more veterans into apartment syndication. The biggest thing that I've seen, I've been in the Marine Corps for the past 22 years. The biggest thing that I've seen is that we don't get enough education about creating generational wealth because the mission is our focus. The commander's intent is our focus. So what we're doing is educating veterans about creating generational wealth. Additionally, what we're doing for our veterans is we're allowing them to come in at a lower price point as far as the minimum investment goes if they have served in any branch of the military. You know, so instead of the 50 grand, we're allowing them to come in at $35,000 minimum investments. And this is because based on the conversation that Heath and I have had over the past year and a half with investors, people that I've served with, people that have communicated with us through the podcast, through our Facebook page, and also LinkedIn, $35,000 seems to be the happy median for them to invest. So one, we want to help them to get their time back so they don't retire from the military and have to work another 20, 30 plus years, right? Additionally, in the next 24 months, we're committed to 1,000 units in acquisition, and that's give us the opportunity to to create a better living condition for 1,000 family. We also committed to donating 10% of our acquisition fee to nonprofit organizations that benefits our veterans. Actually, Eric and I was talking about a couple of days ago about how can we implement and use that money at the properties that we syndicate, to where we can give some veterans the benefits of living in our apartments complexes, and we assist them with that 10% of our acquisition fee. So it's kind of what we want to do in a nutshell over the next 24 months and beyond. So Eric, really appreciate you showing up, answer tons of questions that keep coming in. So please, if you want the recording, put your email information down in the chat. If you don't want to put in the chat to all, just send it to Heath or myself, and we will make sure that you get this recording so you can re-listen to some of those questions that was important to you. Additionally, Eric, anyone who's intended,
Wait, we got one last question.
Okay.
How are you handling payments from tenants that aren't paying their rent due to COVID?
Going out on a doozy there. Challenging right now. We've been fortunate that we've, because of the efforts that we've put into our properties to improve them as drastically as we have, a lot of our tenants are extremely grateful for their newfound living conditions and amenities. So we've been very lucky that our collections have stayed strong. We have 2 tenants in particular that have taken full advantage of the COVID situation and are choosing not to pay rent. And we are in the process. We actually have offered both tenants a buyout, where not only we will forgive their debt, we will put money in their pocket for them to leave. The money we spend, the bad debt's gone. We're never going to get that. So that's written off as far as I'm concerned. I would much rather spend $1,000 and never see them again and put a paying tenant in, and it will be much better for our business plan and our investors to do that. So we're cash for keys right now in those situations when we have to. Last resort, we exercise every option prior, but that's, if needed, we're willing to do that.
Excellent.
And then, do you mind if I plug real fast?
Of course, plug away, sir.
If anybody wants to,
that was coming next.
Yeah, there you go. If anybody wants to get in touch with me, it's my email address is Eric Shirley, my name on the screen, at fouroakscapital.com, FOUR Oaks, OAKS, capital.com. Check out our website. You can check us out on LinkedIn. And then we have an awesome podcast. If anybody's interested in being a guest on the podcast, we'd love to have you. We actually pair a new aspiring syndicator with an experienced syndicator. And the new aspiring syndicator basically runs the interview, asking the experienced syndicator any questions that they might have. It's called Diary of an Apartment Investor. It's hosted by Brian Briscoe, who's one of my partners. Also, Marine, works at the Pentagon. Brian's a great guy, does a great job with that podcast. Diary of an Apartment Investor. Check us out, subscribe to us. Thank you for your time. Thank you for listening to me talk for 2 hours. God bless you.
Yeah, I appreciate it. This was awesome. I'm pretty sure that there's so many details about the underwriting that we could have covered, and we could have gone for another 2+ hours, because it's a pretty important part of the acquisition, as we all know. So Eric, really appreciate you coming out. So we do this every Monday at 7 p.m. Central, and the links are usually the same, but it's really good for us to know who signed up. If you get on meetup.com and register that way, that'd be greatly appreciated. All right. So our Heath, any closing notes?
No, thank you all for staying with us. We usually try to keep this to an hour and a half, and we usually have some networking, but whenever we're getting so much wisdom and getting to discuss so much of something that's very, very critical and important to making sure your deal is going to, 1, work, and 2, that you got a strong business plan for a particular deal. I think that's one of the reasons why so many people stayed on for so long. And we'll do some more networking at the next event if possible. We're getting a lot of great podcasts. You rock, Eric. Thanks, Eric. Thanks, Eric. So Eric does rock. If you guys ever get a chance to just hang out with him, go find a rooftop bar and have some drinks and discuss music.
Yeah, you don't
Or
only rock
surfing.
and
This
roll.
man likes to surf too.
Yeah.
He's got to get me out there. I've never surfed. I've snowboarded and longboarded. Never been on the water on a board. Well, I've wakeboarded, but no surfing.
Yeah.
But
So he rock and roll and he rock and reggae as well. So
yeah, that's
it
right.
makes make him good in my book. He love the reggae music. All right. Oh man. So
Thank you for having me.
I appreciate it. Really appreciate you taking time out. So next week, if you are planning on starting a podcast, next week's topic will interest you, I believe, right? Next week, I believe Brian is coming on to talk about the diary of apartments, the diary of an apartment investor. Let's talk about how to grow your podcast to over 20,000 downloads in a very short time. So we're coming to get some nuggets about that. So Eric talked about it earlier about if you're in the real estate business, marketing is a big part, and having a thought leadership is one of the more important aspect of getting your name out there, getting your face out there, and getting your company out there. All right. So next week, same old time, same places. And hey, please tune in to the Multifamily Real Estate Experiment podcast. We release an episode every Wednesday, and we have some pretty unique guests that comes on that talks about specific topics, right? That has to do with real estate syndication, and also topics from those people who actually provide services to real estate syndicators. So I really appreciate the supporters. And Heath, I think I'm gonna stop talking now.
No,
Thank you all for showing up.
thanks for saying all that. I don't do the asks. So
All right. Thank you,
all
everyone.
right, guys. Everybody have a good night. Rock on.
Good night.